The markets are changing. How do you prepare for that? More right after this. Jonathan and I are sitting here giggling because Bill's not with us today.
And that teaser was
Short.
4 seconds as opposed to 45.
I think that's why they call it a teaser and not a novel.
Now his is the pre-show show.
Yeah.
You know,
See, it's so fun to make fun of him when he's not here.
oh man.
You have joined the Passive Accredited Investor Show. We're so glad you're here with us today. I'm Wendy Sweet. This is Jonathan Davis. Bill is on an airplane, so he can't be with us right now.
I'm sure he is not partaking in any drinks.
That's right. That's right. Sitting in first class, but unfortunately, there are only 2 seats in first class. So
is he on? Do you got a Concorde?
Yeah, a little skinny plane.
Yeah.
But I'm sure he's having a great time. So thanks for joining us again on this show. We are Carolina Capital Management. We are lenders for real estate investors. We lend all over the Southeast.
Mm-hmm.
If you're interested in borrowing money, all you have to do is go to carolinahardmoney.com, click the Apply Now tab. And if you're a passive investor looking to invest some of your money, just click on the Accredited tab. Don't forget to like, share, subscribe, hit the bell,
hit that bell.
All those other exciting things.
That's right.
And don't forget to sign up for Wednesday with Wendy. That's kind of how I feel after they're over. I kind of take my brain and just meld it all together.
Wow. So again, Wednesday with Wendy, you can sign up on a Calendly link. She's booked out until the 1st of September, but you should
third week
of September.
Yeah.
So jump on that and run your ideas, your scenarios, hypotheticals by Wendy, and she'll help you out
and direct you to someone who can help you if I can't, for sure. Yeah. So we have a really, I think, a very interesting, ugly question today.
So we're just going to jump into it. So we're going to go to the ugly question. The ugly question is,
drum roll, please.
I know. How do you prepare for market changes, and how far out do you forecast? Man, that's,
Well, I liked your first answer.
My first, you don't. Yeah. So, I mean, again, I touched on this in our previous episode. Using past data to predict future occurrences, while is helpful, is also skewed, because if you could use past data and the same things were happening again, you would predict the occurrences and correct them before they happen.
That's right.
However, that doesn't happen because different occurrences occur and you can't foresee them because the same things keep happening, but different drivers are forcing them. So how do you prepare for that?
That's right. And I mean, COVID, I think, is a great example of random things that occur. And randomly, we happen to have been at a mastermind event, Freedom Founders, the mastermind event, and they just did it for the trusted advisors. And one of the exercises that they gave us was, you wake up in the morning, the newspaper's at your door, your company has just lost 50% of its business. What are you going to do?
Yeah.
How do you handle it? How do you prepare for that?
Mm-hmm.
It was out of the blue. I even remember when they told us to do that, I thought, that'll never happen.
And then 2 months later, yeah,
COVID hits, right?
Yeah. So it's a good exercise to do. How do you prepare? Well, you put yourself in the best possible scenarios that you can with the information that you have in front of you.
Right.
If you're putting yourself in historically higher risk assets that at this particular time are yielding high yield, well, to me, when I look at that, I say, okay, well, that's a historically, volatile asset, and you're in it, and if something volatile happens, you could take a big loss.
Huge.
So just managing where you're at on your portfolio. You want to be in things. We talked about this before.
Talk about the risk.
Yeah,
that you talked
the
about.
risk. You want to be in things that with fair certainty. You can never know everything, but with fair certainty, what your loss level would be. And then on top of that, you have to know, where is my cutoff point? If my loss, I don't predict that I'll ever lose more than 10% on this asset. But if it gets to 12, that's where I cut ties and just run from it. I just say, here, it's gone. It's, so you have to know those points, because controlling your losses helps you control your profit.
That's right. That's right. And I always am shocked at the people who try to hit a home run every time they get up to the plate, because this isn't a home run game. You were talking about numbers. They don't lie.
They tell good stories.
They do. They tell good stories.
You can get, nothing special. Anyone can make a statistic, say whatever they want it to say.
That's right. That's why we have the federal government. Sorry if I hurt your feelings.
Yeah. So, but the data is important. What's more important than the data is to not get lost in it and solely use it to make the decisions current and future.
That's right.
Because that data was created based on occurrences and factors that are no longer, or maybe less likely, or maybe more likely to occur now. The factors have changed, so you can't use that. It's like people trying to predict the stock market, or hey, this thing always does this. It's like, yeah, but what if this happens? Oh, that's never happened.
Neither did 2008.
Yeah, never did 2008. Never did, COVID. And, I know we could go back to Spanish influenza, but, that's
that's pretty deep.
Yeah. but yeah, you use data, but don't get lost in it. I think that's one of the things, like we were talking about someone who was a, mathematician, or, that's one of the fallacies of that type of mindset, is you look at the numbers and you're like, these are the numbers, these are what it is. And you have to couple that with looking around you and knowing what's happening right now.
That's right.
And, honestly, a little bit of luck and a little bit of intuition.
That's right. That's exactly right. That's exactly right. I said earlier on the other show that we did, I talked about this Facebook post that I thought was really interesting, because we're talking about changing markets, and they're always changing. I mean, that's what this business is. Real estate is a changing market constantly. And we want to make sure that we're able to change with it. That's why we're problem solvers. That's what we do. So I have a friend in Collective Genius that posted this question, and I loved it. He said, we've seen a significant slowdown in the market, with some areas having active prices less than the sold prices. Things that would get multiple offers are now sitting for weeks. Anyone else seeing that? Now, this guy is from California, but I really wanted to share some of the answers, because people in this Collective Genius are located all over the place. So the first guy says, we've seen a slowdown in Chattanooga, but Knoxville seems to be going strong. Same state.
Yep.
Not even that far from each other. These cities are not that far from each other. Chattanooga is more of a resort town. Knoxville is not.
Knoxville's a college town.
Yeah. Yeah. So Knoxville is still going strong. Chattanooga is slowing down a little. I've always said, and it's from data, but I get this, I'm not just making it up. Resort areas drop first.
Yeah. Absolutely.
They go up last, actually, but they drop first.
Yeah.
And they go up quick, like it's more of a straight up.
Yeah.
So you got to be careful in those areas. The other one said, another answer says, we're noticing it slightly in Springfield, Missouri, still very strong though. Appraisals are starting to get squirrely. 100% is another guy says, still a hot market, but definitely signs of cooling down. I like this one too. It says, depending on the property type and location,
Yep.
single family in most areas still going strong, but not getting flooded with offers and showings like they were before.
Mm-hmm.
I like that I can see how many showings agents are getting through showing time. That's what we real estate agent use. They act like they've had a lot of activity, but there aren't any showings scheduled. So that what they're saying is that they can actually see what's going on.
Yeah.
And some of the agents don't realize that. Major softening here in Chicago. Showings and offers are drastically dropped. Even some rehabbed properties are not selling, and we're having to reduce the list price. Let me see who else is here. Market appears to have peaked for us in Arizona in March. That's when they peaked.
Yeah.
Since then, it's flattened considerably, but buyer fatigue has set in. Now, Arizona always tends to be one of the front runners of what's going on.
Yeah.
Like when 2008 hit, Arizona,
Sure.
California, they were in Florida. They were the places that kind of tanked first.
Mm-hmm.
And when they have a comeback, they're the places that come back first. So,
Your sand states.
yeah. So it's something to really keep in mind. Late May seems to be the peak for DC, from somebody else. I like this. It says, it's interesting to hear because I'm hearing about some operators doing apartment syndications in Phoenix, claiming that the market is in high demand for their properties that they are raising capital for. I wonder if their numbers won't be as impressive over the coming years. And then I like this analogy too. We're going to use this analogy, the weather being 110 rather than 120 degrees.
Yeah.
So it's still good.
Yeah.
It's still good, but it's not like it was.
Yeah. I mean, everything's, relative. I mean, it hit its peak in March, and now it's, it seems to be cooling off. Well, it was at 100 and, like you said, 120 degrees in March, but now it's 110 when, on average it's 90 degrees.
Yeah.
It's like, okay, it's still an up market.
Yeah. Even with all of the things across the nation, we are still short on housing.
And affordable housing. I mean, we've talked about this time and time again. It's, and the supply chain issues, the cost issues have really hammered that.
Right.
I mean, and then one other thing is, I harp on this all the time. People are probably tired of me saying this. You have these capital institutions, hedge funds. I mean, the easiest one to recognize, gets the most recognition, is BlackRock. I mean, they are coming in and they are buying all of these homes. I mean, they are pricing out everyone else.
Yeah.
Because they can, because their cost of capital is way lower. I mean, they can have capital at next to 0%, where, if you and I go out there, we're paying, 7, 8, 9, 10, 12,
right.
whatever, 15%,
right,
whatever
right.
it may be. So our cost of capital is much higher. So we're all getting priced out.
Yeah.
And they're doing it because they have the data in front of them that says, millennials aren't going to be homeowners. And then I always think, like, is it chicken or the egg? Are they not going to be homeowners because they don't want to be, and so they're buying up the properties to rent it out to them? Or are they not going to be homeowners because all the properties are being bought out?
That's right. I also heard that millennials are the biggest buyers right now too.
See, and that's not true.
Huh.
So the biggest buying pool right now.
I wonder if it's where you're located.
I don't know. The biggest buying pool right now are 65 and older. That is the largest buying pool there is. Millennials
buying pool, but are they buying the most?
Yeah, absolutely.
Okay.
Yeah, they're buying the most. And millennials, like, everyone's catering a lot of stuff to millennials, but they're not buying. Well,
because they like the experience.
Well, the experience could be it, but it could also be, housing has increased in price. Rates are slowly rising, and most millennials are straddled with more debt than the previous generations.
School loans.
So their DTI doesn't work for conventional loans.
Yeah, that's a very good point.
What's your average millennial have in college loans? I don't know, probably 20, 30,000 at least.
Yeah.
With the prior generations didn't have that.
Yeah. And you think about what they've been through, from what they've seen real estate do, when they can, really remember what they're seeing. They saw their parents go through 2008.
Yep.
and really lose a lot.
Mm-hmm.
And now they're kind of going through something similar.
Yeah.
With the way the home prices are right now, just understanding that real estate to them seems really volatile.
Yeah, it definitely could. I mean, psychological, that'd be an interesting study. I don't know if they've done that, but that'd be an interesting one to know is the psychological effect on home buying of millennials.
That's right.
Yeah, that'd be
And
interesting.
to wear a mask or not
To wear a mask or not to wear a mask.
That would be the good study.
Yeah.
Yeah, it's trying to figure out how you're going to adjust what you're doing for the market is, what do you do? I think everybody's going to have a little different way that they approach it, but we've been saying this over and over again, and that the affordable housing is really almost recession resistant.
It's definitely more so than higher priced houses for sure. Luxury homes. I mean, yeah. It's like, what do you do to forecast out what you need to do in this market? And kind of what I think is, and this is my personal opinion, I hear people all the time telling me, hey, you need to sell your rentals, cash out of them, and really build up that capital stack. And I'm like, okay, then what? Like, so I have to think that the analysts for BlackRock and for all these other hedge funds are smarter than I am. So
I know that kills you to think that, though.
Man, no, that's you always want to be in the room where you're not the smartest. So they see the data, they know that holding these rentals are a good thing. So I would argue, keep all your rentals, keep all of them. Like,
how can it hurt?
I mean, how can it hurt? Okay, so you have your rental, you do a cash out refinance, you keep it 75% or lower LTV, you get a little bit of cash. Yeah, it's gonna be less than you did if you sold it, but now that cash is tax free. Hold on, we got a lot of people talking.
Yeah, so Kong says millennials are buying more now. Do you guys see the hedge funds still buy a lot in Charlotte? I noted that they don't buy many in the suburbs. That's good.
Or just refinance at the lower interest rates and leverage that equity to buy more. Yeah, exactly. Yeah. So Kong, millennials, millennials are buying more. However, what's more? What is more? Are they buying more than they were 5 years ago?
Yeah.
100%.
Yeah, absolutely.
Are they buying more than people 65 and older? No. The data does not support that.
Well, that's a bigger pool of people in the world to begin with.
Well, I mean,
right?
you're talking baby boomers, which is still the largest.
Yeah, we're keeping control of this earth as long as we can.
Do we see hedge funds buying a lot in Charlotte? I noticed they don't buy many in suburbs. So BlackRock has closed 2 deals so far that for several billion. I think one was like 17 billion.
That's some change.
Yeah, so they are buying more, in the MSA, not as much into the suburbs, but they still are buying in the suburbs. But yeah, you're 100% right. They are buying more in the local MSAs. So,
and the thing to keep on top of too is because they do they get everybody else out of the business. Everybody else who wants to buy can't because they're taken over. But don't forget about the little tiny suburbs that touch, the little tiny towns that touch your larger MSA.
Yep.
Those are great markets for all of us to be in because investor can't buy those properties, but people who are wanting to do owner occupied can't buy those properties either because these hedge funds are coming in. And
in a great model right now, and it's been a great one for years, underrepresented for sure. But buying properties, doing pools of properties, and doing rent to own. I mean, I think that's going to be huge now and moving forward because people can't qualify for the conventional loans as much, and if you can do seller financing or a rent to own scenario, lease option or whatever, there's a lot of opportunity there.
Yeah, and Kong is an investor that's he piled up a bunch of lots and he's been building houses and holding them as rentals.
Yep.
So he's doing new construction and holding on to them as rentals, and just refinance them through us recently, right?
Exactly. So you would be hard pressed to find anyone, millionaire, billionaire. Most of them made it through holding assets.
Mm-hmm.
You hold assets, and generational wealth is built through holding assets. So yeah, you can build up capital stacks, but you still have to do something with it.
Right.
I mean, if I hand my kids 50 homes or $50 million, I wonder which one's going to last longer.
Yeah, absolutely.
Yeah.
Absolutely. Because those Porsches and all those cool cars will be in the driveway, but that's absolutely true.
Mm-hmm.
Let's go. Calling the wise is what Andrew's calling him. So I want to talk a little bit about the refinancing at a lower interest rate, and leverage that equity to buy more.
Mm-hmm.
I think it's a great idea, and everybody should be doing that. One of the things that a lot of people who qualify for conventional loans are running into is that they can't get the conventional loans anymore on a second home or non-owner occupied.
Yep.
I can tell you, I had a second home guy call me this morning. That's actually one of our lenders. He's one of our accredited investors in the fund, and he's trying to refinance his second home and pull some cash out of it. And my gosh, this guy qualifies. And I mean, his wife makes even bigger bucks than he did. He just sold his practice. He's got plenty of money in the bank, and they are nitpicking him on, who'd you write this $300 check to? Why are you doing it over and over? It's his housekeeper. I mean, it's just ridiculous what they're asking for to try and get a loan refinanced and get some cash out. So that's a good example of what Fannie Mae is trying to do. They're just trying to dilute completely their second home and investor portfolios. So now everybody's kind of forced to go to these non-qualifying loans.
Yep.
But the people that are kind of left in the middle and can't do anything about it are the second homeowners, because the non-qualifying long-term non-owner occupied loans, they don't do second homes.
Yeah, there's a few that do, but yeah, I mean, like for us on our long-term product, we don't do. I mean, it's non-owner occupied.
Yeah.
Like you need to produce a lease.
Yeah.
So that's that's pretty standard across the industry. If I do know one. I think it's Athos Capital Group. They do non-QM, and I think they do owner occupied.
Right.
So,
I think I'll call him back and tell him that. So Athos is spelled ATHES.
ATHAS.
Awesome. I'll call him back and tell him that. So we're talking about, real estate investors adjusting for the market, but we have to understand that lenders are going to do the same thing.
Yeah.
These big lenders, because you said Athos is doing that now,
Mm-hmm.
we're going to see more and more lenders get smarter on the non-qualifying end and start allowing second homes and things like that. Now they have to be regulated a little bit differently, because second homes are really kind of primary as well, or owner occ anyway.
Owner occ, yeah.
So they're going to be limited as to what they can do. But as we've been seeing the conventional loans kind of dwindle for investors and second homeowners, we've seen them expand on our end with the non-qualifying.
Yep, absolutely. I mean, everyone
Every
knows.
Day it's new.
Everyone knows that they cut it from 14 to 7% on what they're doing, and there's definitely rumblings that
they're going to do it again.
They're going to cut it in half again.
Yeah.
So that's just going to open up a bigger market share for private lenders or aggregators of capital, because you're getting I think I just saw, was it RCN? I think it was RCN. They just did their, no, I'm sorry, it was Two Rock. Two Rock did their first securitization of long-term rental product of 200 and some million. So
that's a lot of bucks.
So there's a lot of people, a lot of capital flooding into that market.
Yeah, because that's not really, it's not where it used to be anymore. And the people making those decisions are investors. They understand our world.
I mean, it's only a matter of time before so much capital floods in, dilutes returns, and then it pulls back out. I mean,
Yeah.
that's just what happens. I mean,
That pendulum
yeah.
swinging back.
I've seen on the investor loan side as low as 3.75. I mean, that's getting really close to what a bank can
to
do.
conventional.
Yeah,
That's exactly right.
It's getting really
Probably
close.
better than a non-owner occupied that you would get conventional.
Well, I mean, it's definitely lower dock and probably happens faster.
Yeah.
Closes faster.
That's just amazing. Yeah,
I mean,
keep it coming.
Yeah, I mean, we're pricing them between 3.9 and 4.5.
Yeah.
Right now. I mean, it's
that's good.
I mean, and the thing is, like, the contrarian thought is, well, how long can this last?
Yeah.
Because we have shiny object syndrome. People start throwing money into an asset because it's safe, but it's safer, perceived safer, and produces a good yield. Well, how long until that lower yield is definitely the safety of it is not a factor anymore. You're like, well, I can't really take that low yield anymore. I got to be a little more aggressive. Yeah. The safety doesn't matter. So let me try something else.
It'll change right back.
And that's what happens. I mean, we saw that in money into the private lending fix and flip space.
Mm-hmm.
It's still there, but I here recently the shift has been moving capital from that
to the long
term.
Yeah, which is amazing because a year ago today, it was almost non-existent, wasn't it?
The long term?
Yeah.
Yeah. Oh yeah.
Non-qualifying long term was almost non-existent.
Yeah. I mean, it was tough to get before COVID, and it shut down pretty much shut.
Even fix and flip did for a lot of people.
Yeah, for a lot of people. So
not us though.
but yeah, it's we'll see what happens. But
yeah.
I wish I had a crystal ball.
That's right. So the question was, how do you prepare for the market changes, right?
Yeah. How do you prepare?
And we'll go back to the original answer that you gave with
I say no, but I mean, you have to, there's so many different factors. I mean, yeah. I was telling Wendy and Bill this story. You take a 10,000, let's just say 10,000 incompetent fund managers, and you give them a 55% chance of losing all their money in 1 year. You give them a 45% chance of making money. And I'm not making this up. I got this from a book. So
it wasn't the internet.
Anyway, it wasn't the internet. Fooled by Randomness was the book. But and so you run that scenario for 5 straight years. And what you end up with is 192, something like that, 192 incompetent fund managers who now have a 5-year track record of making money. Now, original pool was 10,000, but you still have 192 who don't know what they're doing, who still made money. So
dumb luck.
So dumb luck. I mean, it's just numbers. So you can prepare all you want. Sometimes the market just shifts. Your portfolio isn't allocated correctly. You're in something that, that has for the last 100 years been a staple of a society that has returned good yield, and it'll never go down. And then it does.
That's right.
So, prepare all you want. I mean, I would always recommend, look at the data, use the data, look what's happening around in the world around you in your local market, adjust accordingly, and, have a little bit of luck.
That's right. And don't be afraid to make a move.
Yeah. I'm not going to stand up here and tell someone like, I know exactly what to do so that you can avoid all risk in the market.
Yeah.
Like no one, if someone tells you that,
they're full of it.
They're so full, Wendy and I work hard. We analyze deals. We analyze the market. And we still lose money.
That's right. That's right. So invest
money
with us, folks.
Yeah. Now we invest in an asset type that we can control more or less the amount of loss.
The least amount of risk.
Yeah, we can control the amount of loss. So we can like I said before, if you can control your level of losses, you can control your level of yield.
That's right.
To a better extent.
That's right. Well said. What can you sleep with at night?
Yeah.
That's the way to look at it. So you have spent another great half hour with us. We appreciate you doing that. spending that time with us on this passive accredited show. We are Carolina Capital Management. If you are interested in doing a rehab loan, you can go to our website at carolinahardmoney.com, click on the Apply Now button, and you can fill out an application if you're interested in lending with us. I promise we don't lose a lot of money. Just go to the Accredited Investor tab on that same website of carolinahardmoney.com. Don't forget to like, share, subscribe, hit the bell.
It's my favorite one.
Do-
I don't even know where the bell is. I don't even know what that is.
I feel like a ding dong. Sorry, I just had to say it. But we really appreciate you being here, and we hope to see you next week.
Absolutely.
Thanks so much.